So what would you do if the market was crashing right now? What have you done in the past? Today we will provide you with some practical ideas and help you answer these questions if you are in your 40s and 50s. Do you have the right investment mix? What investments do you own and why? Are you ready to buy on the dip? Do you understand your tolerance for risk? Is your focus on the long term? And should you get a second opinion? Hello, Dave here with Living Your Wealth, and welcome to Whiteboard in the Wilderness. I am presenting 6 strategies over a 2-part video series. In today's video, I will be discussing the last 3 strategies: tolerance for risk, focus on the long term, and getting a second opinion. By the end of today's part 1, you will have learned how to determine your goals as they relate to risk, how long it may take to recover from a downturn, and why you should get a second opinion. So as discussed in part 1 of our series, market downturns are normal, and we will never know how long they will last. Gen Xers need to be acutely aware of this information, as we are sometimes closer to retirement than we realize. Understanding that a crash could happen in the future means you can potentially plan for it today. So number 4, do you understand your tolerance for risk? Even though the stock market has its roller coaster moments, the downturns become overshadowed by more extended periods of sustained growth. That is the reality on paper, so try to keep potential storms in context. If only our brains accepted that and did not trigger emotion-driven reactions like selling during market dips and potentially missing the uptick. Investing in the stock market is inherently risky. Risk tolerance is the ability to withstand losses when your investments perform poorly. For instance, how much of a drop in the market can you stomach if you buy stocks? If your tolerance is low, you will invest conservatively. For instance, a more significant portion of your portfolio might be in low-risk bonds and a lesser part in higher-risk stocks. Knowing your risk tolerance helps create a game plan. In many ways, it will drive how you invest. Everyone's risk tolerance is going to be different. Risk is one of the most individualistic Risk is one of the most individualistic elements of financial planning that we encounter. The most important takeaway is that it is okay for it to change as you grow older. We often feel some pressure to keep up with the peers. We often find how quickly most people will tell about their successes, but certainly hide their failures. In our 40s and 50s, as Gen Xers, it is reaching critical mass for making decisions that will impact the rest of our lives. Taking your time to make these decisions is understandable, and that is really what you should be doing. So what are some of these determining factors that drive how much risk we should be willing to take? Goals. The purpose of financial planning is not to accumulate the largest stack of money possible. It is to decide what you want out of life. Calculate how much money you need to reach these goals, and then choose an investment strategy that will deliver the appropriate returns to achieve the income that you will need. So your timeline. Generally, you can take more risks if you have a lot more time to ride out the bumps. If you're going to need the money in 5 or 10 years, that is much different if you need to have 15 years or more. The stock market's overall trajectory across decades is upward, but there are dips and plateaus. A 30-year-old who is saving to retire at 65 has plenty of time to wait those out. But if you are 47 and saving for your daughter's education, she's off to college in 5 years, investing that savings in stocks is too risky because there likely will not be enough time to recoup losses if the stock market drops. Age and life stage. If you're in your 80s, that tolerance may not be as high as it would be for someone who's in their 30s. At 30, you've got time not only to ride out the volatility, but to make more money from working. Portfolio size. Someone who's retiring with $5 million portfolio may be able to take more risks than someone with $500,000. The person with a more extensive portfolio has more cushion if the value drops. Then there's always personal comfort level. Some people are naturally more comfortable with taking risks than others. The bottom line is you have to be able to sleep at night. If the market volatility is too stressful, that's a signal that you need to understand better what to expect or to be in less risky investments. So number 5, is your focus on the long term? Watching your portfolio's value shrink in real time and doing nothing about it can be challenging when the stock market declines. However, if you're investing for the long term, doing nothing can often be the best course of action. Surveys have uncovered that nearly 1/3 of Americans pulled some of or all of their money out of the market during the last 5 financial downturns. Some folks might want to rethink pulling their money if they knew how quickly the portfolio might rebound from the bottom. The most recent market decline was in March of 2020 and recovered in 4 months. Sometimes it can take longer. The market took just 13 months to recover its losses after the most recent sell-off in 2015. Even the Great Recession, a devastating downturn of historic proportion, posted a complete market recovery in just over 5 years. The S&P then posted a compound annual rate of growth of 16% from 2013 to 2017, which includes dividends. If you're wondering why you should wait for your portfolio to get back from zero, remember what happens when you sell investments in a downturn. You lock in your losses. We have seen Gen Xers do this in the March-April market sell-off of just last year. If you plan to re-enter the market at a sunnier time, you'll almost certainly pay for that privilege and sacrifice part, if not all, of the gains from the rebound. Are you curious about how long it would have taken to recover your losses after some of the stock market's major downturns? We have a Gen X focused tool that we can share with you that may help answer this question. So next and last is to get a second opinion. Being an investor is rewarding when the stock market's on a tear and your portfolio increases in value. But when times are tough, self-doubt and ill-advised tactics can take root. Even the most confident saver investor can fall victim to a harmful short-term thinking. Do not let self-doubt sabotage your financial plans. Consider hiring a financial advisor, such as myself, to kick the tires on your portfolio and provide an independent perspective on your financial plan. A bonus is knowing there is someone to call and talk to through the tough times. And actually, sometimes we'll even do a proactive call. So one of the main reasons we provide these videos for you, Gen X, is education and providing objective advice. We want to help you to understand that there are many focus areas in financial planning, at least on a fundamental level. When you plan for the unexpected, the emotional and financial stress often ends up being far less taxing than if you did nothing at all. It is impossible to avoid every unforeseen situation, but we have witnessed firsthand the power of a financial plan. Thank you again, and we hope you have a great day. We would love to hear from you, so please subscribe to our channel and like us if you enjoyed this video. At the close of every video, we will give you a quote from my absolute favorite TV show called The Office. And we want you to guess which character said the line, and there's even extra credit for naming the season and the episode. So please email me actually, at david@livingyourwealth.com with your answer. You couldn't handle my undivided attention. You know, there's only one character that's that idiotic and arrogant. Thank you very much, and we hope you have a wonderful day.